Good morning, good morning. I know we're catching up with old friends here, but let's go ahead and get started. I know when I go to events, I like to start on time, end on time. I don't respect everyone's schedule twice, so let's go ahead and get started. For those of you who don't know me, my name is Ryan Dudlett, and I am a senior charitable giving advisor here at the Community Foundation of Greater Des Moines, and I'm very honored you all took time out of your schedule to be here today. We're very excited about our speaker, Tiffany, and the topic. We think it's very timely and relevant. So a lot of clients, aging population, wealth transfer. So real excited to dive into this. Before we get started, I want to do some housekeeping and a quick introduction of the Community Foundation for those of you who aren't familiar with us. This is a hybrid meeting, so you'll see me sometimes look up at a camera in the back corner. We have advisors joining us from around the state of Iowa, not just in this room. Housekeeping wise, if you haven't been to this area before, if you come out this hallway to the left, you'll see a kitchen area. Right behind that are our bathrooms. We also have water out there. There's refreshments here up front. For continuing education, towards the end of the presentation, we'll send around a sign-up sheet for CFP type information, CLE. We'll also have CPE certificates on the table as you walk out the door if you need those credits as well. For those joining on Zoom, we are taking questions and answers. So please put those in the chat or the Q&A feature. And I think throughout, Tiffany will be answering some questions. We'll definitely answer questions at the end as well. And we'll do our best for those attending virtual to answer some of those questions as well. You can advance the slide, please. Oh, thank you. So most of you I have met with, and you know the Community Foundation, but potentially you need a refresher. Some of you might be new, especially virtually. So I just want to do a real brief introduction. Again, Community Foundation of Greater Des Moines, our mission is to improve the quality of life for all by promoting charitable giving, connecting donors with causes they care about, and providing leadership on important community issues. So we're doing a lot of work. We are a nonprofit organization, but at the end of the day, we're here to just elevate our community and elevate the waterline of giving. We have a lot of tools, strategies here at the Community Foundation that we can offer, especially to our professional advisors and their clients. So always happy to sit down with you or meet your team. If you have other advisors that you want to hear this type of information, feel free to reach out to me. That's my core function, is engaging with our professional advisors. So wealth planners, tax planners, estate planners, bank, trust officers, whoever that might be. It's always happy to meet with you. Next slide, please. Only other thing I'll share is just a quick dashboard. So again, for those who aren't familiar, we have a 55-year-old history in the Des Moines metro area and have built a reputation over time and a lot of trust with the advisor community. And we don't take that lightly. As you can see, a lot of people have put their trust in us. We steward over 2,600 different charitable funds, donor advised funds, endowments, other types of funds. So over $1 billion in charitable assets. So we feel very fortunate that people like yourselves have trusted us to work with your clients. And again, we don't take that lightly. We take our jobs very seriously and we want to put our best foot forward with you. You'll see in 2023, our community granted out $62 million and brought in a new $79 million in gifts. So strength in numbers there. And then the last two numbers I'll share is we also have affiliate community foundations sprinkled across the state. And what does that mean? Well, we can't be everywhere in the state of Iowa. We don't have deep relationships in all of our rural communities, but we have leadership in these different areas of the state that are doing the same work. And we're a host foundation. So we support them in the back end with our infrastructure, with our accounting team. And so there's local people across the state that are working with donors to support this kind of work. And then lastly, for those who are financial planners or investment advisors, we offer a program called our Charitable Investment Partner Program. Not all community foundations offer this, so we're very fortunate here in the state to have something like this, which allows your clients, if they choose to set up a charitable fund, to allow you, their trusted advisor, to continue to invest those dollars. So again, that's my brief commercial. I'm going to go ahead and introduce our guest speaker, who you are all here to see today, not me, Tiffany House. So Tiffany is a CEO of two different companies based out of Phoenix, Tax and Estate Strategy, which focuses on clients with families and individuals to help them with their philanthropic planning. She also is the CEO of the Gift Planning Institute. which works more with nonprofit organizations and their plan giving programs. So really just a charitable strategist that comes around in all sorts of ways. She has the Chartered Advisor in Philanthropy designation, Certified Exit Planning Advisor, many others, which I'm not going to continue to read, a lot of initials after her name. She's a national speaker, very active in her own community, serving on different boards. And on a personal level, lives on an urban farm in Scottsdale, Arizona, with a wide variety of animals, including horses, dogs, cats, bunnies, chickens, turkeys, ducks. I'll let her get into all of that. It's very interesting. So please help me welcome Tiffany.
Well, it's a pleasure to be here today. Actually, this is my returning visit to Iowa. I was just here in Des Moines less than a month ago. My sister, I have a half sister, and she was raised here. And so we came into the Sisters Weekend in Des Moines. So it was quite nice. And as I was walking up, my clock decided to stop working. I have no idea why it went blank. So I guess I will just keep on my watch then to make sure that we're on time since that stopped working for me. So hello, it's wonderful to be here. I love getting out of the heat of Arizona, and oh my gosh, it was 109 yesterday. So it is fabulous to be here. I want to get into sharing with you about tax advantage business sales and how we can help the wealth transfer. And first of all, I want this to be very interactive and lots of fun. So please ask questions. Let's make it interactive and fun. If you have a particular something to share or a scenario that you want to include, please bring that up. I call myself a recovering financial advisor. So I was in the industry. I worked for 17 years with my father, and we focused on ultra high net worth individuals across the country. I was actually born in Minnesota, right on the both my parents are Iowegians, and I was born in Fairmont, Minnesota, and so love the Midwest and all of the wonderful things that it provides. Also in Arizona, most of us are Midwesterners, so we're a very friendly state. But my background comes from tax advantage planning, where we focused on asset protection, estate planning, and finding tax advantage solutions. Personally, I'm very charitable, and my family, we have our own donor advice fund where my kids get to grant from twice a year. They're supposed to, well, they do the research for the grants and they're supposed to volunteer, but that doesn't always happen. And also 10% of our estate goes to charity. So when I get to meet with a client, I want to look at their scenario, but typically the tax advantaged solutions that I'm going to look at first are usually charitable, because they've been in the tax code since 1969. So it makes them very well entrenched. And when you look at the benefits, we'll go through some particular examples. It can be so great for our clients and also for advisors. So how many people here are in the financial planning world? Okay, how many in the legal? All right. Oh, you're the only one. Tax planning. Let me see. Okay. Ooh, wow. This is the best showing I've had in that realm. So great. Thank you. Percentage wise. For the financial advising people in the room, we really have an opportunity to actually get more assets under management while we help our clients with some of these tax advantage planning strategies. Today, we're going to go beyond just the tax advantage strategies, and we'll get into other things as well. But we'll always start with the tax advantage, or I'm sorry, the charitable ones. So what we're going to talk about today is the opportunities out there for advisors. I don't think that you can get into dealing with clients or donors without understanding a little bit of their psychology. Business owners are their own beasts. So we'll get into that. We'll also discuss the structure of the company. I see that you guys have some of my handouts out there. We'll If it's an S Corp, C Corp, LLC, it depends on the tools that we can utilize via the structure of the business, and S Corps are most common. We're gonna get into a few planning tools, quite a few actually. And we'll touch on some case studies as we go through those. We have an hour and a half together today, so we'll have some fun doing that. And the most important theme here is it's not as complicated as it might seem. Some of these planning tools and strategies require a team. You need your financial, your tax, your legal, your community foundation, your philanthropic passions and desires to come together to create what's best for our clients. I'm not going to go through all of the slides. Some of them are just there for your later reference. If they have a lot of words, typically that means I'm going to skip over them. And again, love questions or interaction. If you have some comment that can add value to the rest of the group, please do not hesitate. So they say we have a $30 trillion opportunity out there as we go into the largest wealth transfer that has ever been. So with that, we have baby boomers retiring. And how do you know how many baby boomers are retiring? You gotta trust Google, right? So asking Google how many retire today, there's 10,000 baby boomers retiring each and every day. They're getting out of their businesses. And 40% of baby boomers are small business owners. So how much of those 10,000 people retiring every day are actually business owners that are looking to transition their business? This is a great opportunity for us. Also, if you ask business owners if having, the question up on top, having a transition strategy is important to them and their business, you'll see that 99% of them agree. However, 79% of them have no written transition plan. 48% have done no planning at all. And 94% have no written third act plan about what they're going to do actually after their business. And that's actually important for business owners because they have been the kings of their own kingdom for quite some time. And if they don't have an idea of what it is that they want to do afterwards, it can be very difficult to get them to transition businesses. So in the exit planning community, they say that about 75% of the time when deals do not go through is because the owner was not ready. And as we look around the room and where we're at, what about helping our business owners find ways to give back to community if they're getting out of their business? So being a board member, giving their time, talent, treasure to organizations can also be very helpful. But the point here is business owners know they need a plan, but they don't have a plan. Also, entrepreneurs are 50% more likely to be philanthropic. And why is this? Personally, I believe it is because most of them have been mentored at some point in time in their life. People have given to them and to their success, and they're very willing to give back to the community. They also will donate more of their time and volunteer more than non-entrepreneurs. So as we look at our entrepreneurs who are aging, who are a lot of them business owners, who don't have a plan and who are philanthropic, it's really the perfect time to talk to them about preparing them and their business for sale. So it's the perfect storm for tax advantage business sales. I think it's really important, as I mentioned, to understand the psychology of a business owner. And coming from Arizona, I drink a lot of water. So most business owners, 50% of the time, they have they have leveraged their home at least 3 times to fund their business. So these are people who are not risk adverse. You're not going to go to a business owner and try to scare them into, well, you know what, if you don't make a plan for what's coming down for your business, It could, the business could just fade away. It's hard to scare them like that because they have taken so much risk in their success to get to where they are, that that's not a motivating factor. They spend the majority of their time working in their business, not on their business. So they might know they need to make plans for the future, but they're too busy in day-to-day interactions to actually spend the time to look at the future and what planning they might need to do. They do not like to be told what to do, no matter how much they're paying you for advice. They think that they're the king of their own kingdoms, and so they don't like to be told what to do. So we have to be creative in how we talk to business owners about transitioning their business. And like I mentioned, a lot of them have been mentored, and I think that's part of the reason why they're so philanthropic. And they are the most generous class of people out there. So business owners are not dogs, and that's my puppy Oso. She's a Great Pyrenees and watches out for all of my chickens and ducks and turkeys and animals outside. They don't want to be told what to do. Business owners are cats. How do you get a cat to do what you want them to do? Well, you have to point the laser pointer at the right spot on the wall for them to think that it's their own idea. So how do we do that? How do we get business owners to take action? How do we point that laser pointer at the right spot? In my opinion, I think everything comes down to stories. I think that's what best way we brand ourselves. I think that that's a great way to convey information to our clients. So telling stories about other business owners and the situations that they incurred and the outcomes that then resulted, I think can be a really effective way to have these conversations. So the structure of the business matters. We're going to kind of get into S Corp, C Corp, LLC. Partnership is something that I don't get deep into because a partnership, you have to read the documents. So you never know exactly what strategies you can do with a partnership until you actually read the partnership document. So this is a cheat sheet that I put together, and you'll see the top kind of yellowish. Is it an S Corp, a C Corp, an LLC, or an asset? And there's different color coding in here. Well, I mean, if it's lighter coloring, that typically means it's not one of my favorite strategies, or there might be some things that can get in the way. Can you put S Corp stock into a donor advised fund? The answer is it depends, like any good legal advice, right? So if a donor advised fund program, and I'm guessing like the Community Foundation of Greater Des Moines is set up like a corporation, they're not able to handle S Corp stock typically, or things that have UBTI, unrelated business taxable income. However, there are donor advised fund programs that are set up like a trust that can handle some more of those complex assets. I'm going to remove deferred sales trust here because it's about to become a listed transaction. So I think I even removed it from the presentation. And I'm going to replace it with a 301 redemption for S Corp stock. But these are a lot of the tools that we're going to get into, not all of them and not all of them in full depth, but there's a wide range of tools. And of course, the charitable ones are on top, right? Because those are well entrenched in the tax code. They're great for our clients and allows us a lot of flexibility.
Quick question.
Yeah.
So you said lighter is less favorable.
For me. Yeah.
So does that make pink the most favorable?
It was just really kind of purple pink. You just
So the
do
darker
different
is
colors.
more favorable.
Darker is more favorable, yes. And like a private foundation, if you put an asset, and I like to tell my nonprofit comrades that cash is for amateurs. If you're going to give something, give an asset, highly appreciated assets mostly. And if you put that into a private foundation, you only get to deduct basis. And there are ways out there of structuring a supporting organization to look like a private foundation and accomplish a bit more creative planning that way. Any other questions? Okay, so how are businesses sold? So there's two different types of sales. There's stock sales and asset sales. So asset sales are the most common type of sale, and especially for S-type corporations. So what happens with an asset sale is you have both ordinary income and capital gains taxation at the time of sale. It kind of depends on how the deal is structured. Usually the buyer is the one who structures how the assets are going to be listed in the transaction. And something as simple as personal goodwill is taxed at capital gains tax, and corporate goodwill is taxed at ordinary income tax. So it depends on how the deal is structured. So why are we having so many asset sales? Because people don't want to deal with the lingering liability of the previous corporation, and they want to get a new step up in basis for the assets. So if they just bought the stock, which is only taxed at capital gains taxes, more tax efficient and more simplistic for the seller, they can, but then they will have to deal with that liability, and they don't get the step up in basis in the assets.
Sorry. no.
Yeah, no, please.
I think you implied that we would get access to the
Mhm.
deck at later.
Uh-huh.
Sure. Thank you.
Correct, Ryan, will you, I did provide a PDF version of it, so yes.
Slides and a recording will go out after.
So how does this look? Let's just take an example of $1 million business sale. That gets, if we were to just say, let's do it as a stock sale for simplistic reasons. We have 20% federal capital gains tax rate. At $1 million, they're likely gonna have to pay the 3.8 net investment income tax or the Medicare tax as well. And then the state tax, and oh, I apologize, I forgot to look yesterday. What's the state tax here in Iowa? 5? Okay, 5, great. That's exactly what I use in my example, so we're good. So, and then we have the state tax, and in California, I should actually update this slide. I believe it's up to 14% now in California. So if we take a look at that, that can be a significant taxation on the sale of a business. 20 to 30% or 35% of the business owner's assets can go to the IRS, and that's just if it's a stock sale. What if we look at it being an actual asset sale and we have some portion of that coming out as ordinary income? So certainly a place where we can help our business owners to maximize what they're able to come out of their business with. So when's the best time to start planning? Yesterday. So the sooner that we are able to get in, we can do some great things, probably as our lawyer in the room knows. So we can do some gifting to children. We can do gifting to spouses. If we're 5-10 years out of a business transition, we can gift assets to those who are not in a high tax situation and really be able to allow those assets then to grow outside of the gift, especially when we have the estate tax exemption at $13.61 million. So if we get in front of our business owners and start having this conversation, there's some great things that we can do ahead of time. There was a plastics company, actually out of Minnesota, that I helped sell. And 5 years ahead of the sale, we weren't sure when the sale was going to happen, but we went ahead and gifted those interests to the children, used the estate tax exemption. Now those assets grew outside of the estate tax realm. And when the business sale actually happened, then we were able to get those assets outside of the estate and do some good tax advantage planning. I like to have interesting transitions in my slides because some of the topics that I talk about can get a little dry, and so I like to make it as fun as possible. So let's get into some of the tools and strategies. So donor advised funds is one of the best tools and strategies that we can use, and it's very simplistic. So our community foundation here of Greater Des Moines can also help with these. And it's a great December planning tool as we're getting into the end of the year. It's one of those, oh no, I did a big taxable event this year. I sold my business or did something else. What am I going to do? What about pre-funding your philanthropy? So it works really good for a wide variety of people. I have these on most of my slides of who the ideal candidate is, and that's again for your reference later. So what we do is we take a sponsoring 501c3 like the Community Foundation of Greater Des Moines, and the donors then able to create their own fund inside of it. And they can name it whatever they want. They can even name it as a foundation. So those who liked private foundations, the rules around private foundations have gotten onerous and it has become a barrier to entry for me. At least I'm going to look at a donor advised fund or a supporting organization usually instead of a private foundation. But why not call it the Hogan Family Foundation? There's a lot of opportunity there to create the intention of the family, but using a simple tool like a donor advised fund. Because the donor makes the gift, and at the time of the gift, they get the tax deduction. And then over time, they're able to gift to charity when and how they see fit. We don't have to deal with that 5% rule for private foundations. Honestly, for me, private foundations are a good tool if you want to pay family members or take really expensive board retreats. They can still be a great tool. Otherwise, donor advised funds are able to help us because we can sell the asset tax-free inside of the donor advised fund, and we get tax-free compounding growth. So I worked with the latest donor advised fund that I did was last year on December 27th. I was working with an executive from a hospital, and the hospital hired me to come in and talk to him about his giving. And he said, Tiffany, nobody knows this, but I'm retiring next year. And I said, well, that's great, but you've been giving $125,000 to the hospital each year and other charities. So he was giving about $150 a year. And he was not old enough to start taking from his IRA, because at 70, we can start taking qualified charitable distributions from our IRAs. And so I said, well, why don't you pre-fund a donor advised fund the year that you need the tax benefit? So that was the latest donor advised fund I ever did. Anybody do one at the end of December like that? Yeah, I'm sure you have, John. John and I go.
Many times.
Yeah. Well, I think with that one, I went to Morgan Stanley because that was his financial advisor. And they said, oh no, you would have had to have done it in the beginning of December to get that accomplished. And I called his local community foundation. They said, sure, we'll get this done.
Right.
What about you, Brian? When's the latest you guys have ever done a donor advice? And I know that's pushing it. I'm not trying to say anything.
Plead the fifth there. The earlier the better. Yeah, always happy to take the call and do our best to get through it.
Yeah. So they're simple to set up, a great tool and strategy for end of year planning. The thing that I love the most about donor advised funds is the opportunity to teach the next generation. So I have my own donor advised fund, but I think also with some of our wealthy families, having grandparents set up a donor advised fund and have the grandkids come in and actually learn how to grant from them. And so I'm doing a poor job of it in my family, but the ideal situation would be having the children do the education about the nonprofit organizations, then having them come and do a proposal where they actually have to, depending on their age, write and draft something that they're going to then present to the grandparents. And they're getting public speaking, they're getting business savvy, they're learning and being educated along the way. So I think it's a great way for us to teach philanthropy to the next generation. And a donor advised fund can be the charitable beneficiary of a lot of the tools that I'm going to talk about today. And honestly, I've worked on over 40 charitable trusts in my days, and I have always had a donor advised fund be at least part of the charitable distribution in the future. So supporting organization. I think that these have lost favor. People aren't talking about them enough. I mentioned, sorry, not a fan of private foundations, because if you can only deduct a basis and you're giving an asset, like why even give an asset? Private foundations are good for cash, good for paying your kids to be on the board and taking expensive board retreats. A supporting organization can be set up like a private foundation. So it did get a bad name because there's three types of supporting organizations, type 1, type 2, and type 3. Type 3 was very flexible. And so when they came and did more strict rules for private foundations, they also included type 3 supporting organizations. So they are more heavily regulated. The type 1 and type 2 are still great tools to be utilized and really can come into favor. So where I'm working on a supporting organization right now, I think sometimes stories are the best, right? Share examples. So I know this is a fabulous thing, but I was speaking at the Financial Planning Association National Conference last year. And somebody came up to me afterwards and she said, my husband's going to sell his business and we need to talk to you. So I got together with them and and this is real. They said, we want to give half. We have this, it's a fintech company. It is out of California, but they moved to Arizona for the tax situation because they're much more favorable than California. And so they have $100 million company that they know some of the big players are going to come in and make an offer on soon. And they said, we only need like 5 to 10 million. Like, we're not going to go buy some extreme mansion or anything like that. We want to give half of those assets away. So what I helped them do, well, I in that first meeting, I said to them, I'm like, well, you need a supporting organization. And they said, we interviewed 4 attorneys in Arizona, estate planning attorneys, and nobody's told us about a supporting organization. Why? And you'll see in your materials, I have a comparison of a supporting organization, private foundation, and a donor advised fund. And this gentleman is a genius, and he wants to invest and get into some venture capital and those types of things. So I said, well, if you do a supporting organization, you can make it look like a private foundation and support a class of nonprofits. And you can support a class of nonprofits that a donor advised fund program, like the Community Foundation or otherwise, so that can be your supported organization is a class of nonprofits. And then you just need to have board members on your board that are from that class of nonprofits that you're working with. And I know John Severson here works with Brian Clance, and Brian Clance is actually the one we're going to use in this example. We're going to use his donor advised fund program, and he's going to provide those board members and do the administration for the supporting organization for these people. However, logistically, and I don't have that in my slides, in this slide. I do have a flow chart of how I put their case together, but we're going to do spousal lifetime access trusts, but we're taking the shares and we're going to discount. We're going to do voting and non-voting. We're going to discount the non-voting shares, put those into slats. We're going to take the voting shares, do 30% of their adjusted gross income at the time of sale into a supporting organization, because that's our max, but they wanted to give 50. So we're also going to do a donor advised fund at the time of sale. So supporting organizations, like I said, need to support a charity or a class of charities. And then your clients, they can then be on the board of directors, but they need to have board members from the supported class as well. So this provides us kind of a workaround around some of those onerous private foundation rules. As I mentioned, type 3 was very flexible, but the Pension Act cracked down on them. And so now we typically use type 1. And this is my comparison, I had to put it in 2 slides, of private foundation supporting organization and donor advised fund. There's some times where a private foundation can be a great tool, but typically I like to look at using a donor advised fund or supporting organization instead. Any questions so far? Or comments? Yeah.
When you talk about class of charities, what do you mean by that?
The class of charity could be, it could be religious, it could be a class of charities that a donor advised fund program is supporting. So the class of charity could be what the Community Foundation of Greater Des Moines, the charities that they support. And really, when you look at the class like that, you know that the Community Foundation would support any charity, right? So it really gives you availability to work with any charity. It helps you get the board members and favorable board members by supporting a class of charities. Did that answer your question?
What do the board members do? Do they have to approve every grant or what's the role of the board?
Great question. They're there to manage. They do not have to be there for every grant. I do not know exactly what the requirements are of how often they have to meet and what stipulations, but they need to, look at the assets under management, make sure that they're prudent and do those type of fiduciary responsibilities. So it gives you more flexibility, right? Yes.
Tiffany, when would you use a supporting org compared to a DAF?
So the reason that I chose it for the couple that I had mentioned is because he wants to do some strategic investing and keep his brain going. And a donor advised fund, sometimes the investments that you're allowed to invest in are going to be more restrictive. So supporting organization or a family foundation, I look at the $5 to $10 million plus level. When you're getting into those types of assets and those types of clients who want to have control, and what business owner doesn't want to have control? But I don't know that it would be worth putting it all together if you're looking at, $1 million of assets to do a supporting organization or a private foundation.
So it's primarily the investment piece, so get outside the publicly traded stuff.
Yeah, I think it offers more flexibility there and gives a feeling of more control. But donor advice are great.
I don't see any other advantage. Are there any other advantages to doing this? So,
Great question. I'm gonna have to think more on that. Yeah.
okay. Well, that's a good enough one.
Yeah.
What are the setup costs associated with the supporting?
So you have to have the attorney draft the document. And then you're gonna have, when you're supporting a class of nonprofits, you're going to then have administration costs and you need to have the board of directors. And so there's regulatory stuff. I do not have a number for you, but there will be additional costs for sure. And I'm sorry, Kristen, you had a question too?
I was just gonna say, it sounds like there'd be more involvement.
Yeah. Okay, so charitable trusts, my favorite thing on the planet. I love charitable trusts and hopefully you guys are fairly familiar with them. I do have a cheat sheet that's just about charitable trusts in there. But I think that when people talk about charitable trusts, they get into the weeds. And I don't think that we need to get into the weeds on them. Whether it's a uni trust or an annuity trust or what have you, that's going to come later on. Let's just start having the conversation with our donors about charitable trusts and how they can benefit. And the biggest thing that I want you to get out of this is it depends on what tax problem you're trying to solve as to which type of trust you're going to look at. If you have a capital gains tax issue, you're going to look at a charitable remainder trust. That's going to help you with capital gains taxes. I had a friend, and I'm not in Arizona, so I can share this, but he wanted to learn more about charitable trusts. So he funded a charitable remainder trust with cash, and it was pointless. And it doesn't work. You need to have a capital gains tax reason, in my opinion. I don't ever like to do more planning than we have to. And when I use any type of tool, I'm only gonna try and solve for the tax portion that we need to solve and not get into the weeds on everything else. So a charitable remainder trust is for capital gains taxes. Yes, it can help with estate taxes. It can help, it does give you an income tax deduction, can help you with depreciation recapture. But when we have a capital gains tax asset, we're gonna look at a charitable remainder trust. A grantor style charitable lead trust, that is for income tax issues. We're gonna get an upfront income tax deduction for our later gifts. And then just a straight out charitable lead trust is for estate taxes. Has anybody ever told you that estate taxes are optional? You can put a testamentary charitable lead trust inside a dynasty trust or other trust and never have to worry about paying any estate taxes, even if the exemption goes down and we sunset like I'm expecting us to do next year. And that couple that I talked about with the $100 million business, I did also in their plan put in a charitable lead trust for any assets that are, because they have one son. I think with their spousal lifetime access trust with discounted stocks at 13.61 million each is enough for him to make it 20 or 30 years until he can then get the assets out of the lead trust estate tax rate. Oh, sorry about that, save to PC, but your version does not have that. This is just a tools matrix that I love tools matrix because I think it takes complex information and creates it less complex. You'll notice I have donor advised one and supporting organization here with an asterisk, meaning that they can be drafted like a trust versus a corporation, which gives them more flexibility in dealing with more complex assets. Also, I have pooled income funds on here. How many people here have heard about pooled income funds? All right, awesome. Of course you have, John.
That one.
Oh, I love it. That's awesome.
Really works good.
Yeah, no, they're fabulous. We're gonna get into those today because I think they're an underutilized tool. So this just kind of goes into, okay, what's your tax savings, your adjusted gross income limits? Where's the remainder going? Do they get income? Can they keep control? For me, business owners always want control. So that's a big part of it. So a lot of people say that charitable trusts are complex. I don't think so. I think they're flexible. And there's a lot of tools and levers that we can kind of manipulate in there, and we can really make them be a great fit for our clients. And so I see them as a Swiss Army knife of planning. We'll first get into charitable remainder trust. So this, how many of you have heard that guy on CNBC screaming at you about what stocks you should buy? Jim Cramer on Mad Money, you guys know him? Yeah. So when he discloses what stocks he personally owns, he always states that he owns those stocks in his own family charitable remainder trust. So just to let you know, people out there that you know, or you, I don't know, I don't like it screaming at me, but they are utilizing this type of tool. And it's been in the tax code. All charitable trusts and pooled income funds have been in the tax code since 1969. They've been around. So I worked with my dad for 19 years. We did a lot of extremely complex planning for very high net worth individuals. And I like to say that my dad was a little fringy on the tax code. I don't like to be fringy, and there's nothing fringy about a charitable remainder trust. They're well entrenched. We know how they work, and you don't have to worry about the IRS changing their mind tomorrow. So general theme of things, I like to look at it as an asset as the apple tree, and the donor gets to manage that asset. They get to be trustee. They get to fertilize that asset. They get to choose how it's going to grow. And they're also able to get the apples or the income from the trust. And now the trust over the apple tree goes into the trust. And then at the end of life or a term of years and or both, that tree will then pass on to charity. So this is a great tool. And in my perspective, you don't even have to be charitable. So take a look at this tool. And I know we want to make a community impact, and sure, the remainder interest goes to charity in the future. there are other tools that will actually give now, but at least we're giving something. And Dr. Russell James of Texas Tech University, he has studies out there that when people decide to leave a gift in their estate plan, that their annual giving more than doubles because they've made that commitment. So even if somebody does decide to do a charitable remainder trust, it can enhance gifting now. So that's our ideal client. We're gonna get right into it. So I mentioned earlier that I don't ever like to overutilize any tool. So we're gonna take a $2 million business, but let's split that in half. Because we don't want the tax tail to wag the dog, and we only want to accomplish as much tax advantage planning as we need. There's no sense in overdoing it. A charitable remainder trust is an irrevocable trust. So let's not put too much of any type of asset inside a CRT. So we're gonna take half. We're gonna take the business interest of 1 million. We're saying no basis here to make calculations easy. And we go ahead and transfer that into a charitable remainder trust. And in so doing, we save $288,000 in taxes. Where did I get that number from? 20% federal, 3% or capital gains federal rate, 3.8 net investment income tax, like we mentioned, and then 5% state tax. See, I told you your 5% was going to come in handy. So we're going to save $288,000 at the time of the sale. And now, because after death second, we're going to give that money to charity, we get an income tax deduction today for that future gift. So for these two 60-year-olds, their income tax deduction was $266,000. Now, they're able to take distributions. They chose a 5% distribution from this trust. So their first year distribution is $50,000. This is the type of trust that will grow with the assets, so the income will potentially grow. As long as it's invested well, right? You financial advisors out there. And for their 34-year life expectancy, that's going to give them $2.4 million. Now, this couple did not want to disinherit their children. So we went ahead and bought life insurance. That took about $200,000. We did a 10-pay. And so their total lifetime income went down to 2.2 after paying those premiums. The kids' inheritance is $1 million. Charity or their own donor advised fund is getting nearly $2 million. But let's take a look at that income tax deduction. Now, they sold the other half outside of the charitable trust, right? So they're in their highest tax year. So at a 40% tax bracket, they're saving $106,000. So it's $106,000 back in their pocket. And when you look at the total tax savings, it's almost $400,000. The power of this type of tool is keeping your taxes working for you. Rather than giving it to the government, let's keep those monies, let's invest them, and let's have our lifetime income come from some of our tax savings as well. And obviously, we can use that to help offset the outright sale that we sold outside of the trust. I'm going to go into an example that shows no trust and then compare the two. But any questions before I move on?
Can you go through that 106, the far right green box, do that stuff again?
So what we're looking at here, so we have our income tax deduction of $266,000, and at a 40% income tax bracket, that comes down to $106,000. So that is what is actually that they're actually able to save, because they get the deduction, but
It's not, okay.
it's not, it's not money back in their pocket, but the 106 is back in their pocket at the highest tax bracket. Thank you. Any other questions? Well, there's a lot of fun with these tools. So questions can always come up at any point in time, and never be afraid to come back and ask. So let's compare apples to apples. I'm like apple trees. And let's just look at that $1 million. Let's forget about the million of the business that was sold outside. So we're going to take a look at the $1 million portion of the business, and we're going to sell it, and we're going to pay our capital gains tax. So now we only have 712 in an investment portfolio working for us. Let's take that same 5% that we took initially with the charitable trust, And that only gives them $35,000 their first year. Their lifetime income is 1.5. The inheritance goes up a little bit to $1.2 million. Charity gets nothing, and the IRS wins. So let's take a look at what it looks like compared side by side. So on the left, we have the sale with no trust. On the right, we have using a charitable remainder trust. So our lifetime income went up from 1.5 to 2.2 after we paid life insurance premiums. Our inheritance went down a little bit, but we could have bought more life insurance if we really wanted to replace the full asset. And charity won with nearly $2 million, but again, that could be a donor advised fund as well for all or a portion of that charitable beneficiary. And then to your point about the in the income tax savings. So we had the $266,000 deduction. And we set it a 40% tax bracket. That was $106,000 left in their back in their pocket. So let's grow that at the 7% for their same life expectancy. And that's another $1 million that they are able to get by keeping those assets and not sending them off to the IRS. So we're looking at a total of a $3.6 million benefit for this family by using a charitable remainder trust. And somebody who's not charitable will be like, yeah, right, but charity got $2 million. Yes, but still on $1 million asset, this family came out 1.6 million ahead. That's pretty significant in my opinion. Now, where doesn't this work? If they don't live to life expectancy. If they don't live that long, obviously their lifetime income would go down. But John, with gift annuities, right? I'm sure that you're well aware that people who give live longer because they're happier. They're the happy people. So when you give, you're automatically increasing your life expectancy by 5 to 7 years.
Statistically proven, yes.
What is the actual number? Is there a number of how many years do you think you can come up off the top of your head?
It's more.
Yeah.
There are reasons for that. Usually it's a higher economic class doing it in the first place.
Yep.
And usually they're healthier folks to begin with. And they have less worries because they have more income. Well, what do you want?
Well, and in my opinion, I think that giving makes you happy and happy people live longer, right? So I share this with donors and nonprofits too, that when you create your legacy of leaving something to charity at the end of your life, you get to live into that legacy each and every day. Like, how much happier does that have you be when you get to wake up in the morning? I think it's a huge impact. As I mentioned, a lot of talk that I'm not going to go through with these slides. One thing to point out though is, actually I was just on a call about this yesterday and I had done this before. So I used Royal Bank of Canada stock. We did about $10 million of that into a charitable remainder trust. And we were able to convert a $3.6 million IRA into a Roth using that tax deduction. So it was called in yesterday on a family that's about, took it at the airport, but about $40 million. And they want to convert to a Roth. What a great way to do it. And they also have highly appreciated stock that we might look to do this type of tool with. And so one bad thing, I know I just told you this great thing about charitable remainder trust and all of that. I think I forgot to mention this fact. About 75% of companies out there are S Corps. You can't do an S Corp inside a charitable remainder trust. So it works great for highly appreciated assets, but you cannot do it with S corporations or unrelated business taxable income assets. Now, where I had fun with this tool, so I had a family, he was a dermatologist and he had his own practice. They'd already sold to a private equity company and there was a second sale. So he kept a portion of the stock. So now there was a second sale to another private equity company coming down about 5 years after the initial sale. So they brought me in because they had heard about charitable remainder trusts and the power that they can accomplish. So as I'm sitting down with this family, I get to know them, right? We have to make sure no sense in doing any tool unless it fits inside their estate plan. And they understand it. And so education is important, making sure that they have all the tools and information they need to fully comprehend one of these strategies is crucial. And like my work now, I gave up all my licensing as a financial advisor, so I get to work as a fiduciary with the tax, legal, and financial advisors included on this. So as I'm getting to know them, they share with me that their oldest son is an attorney, and there was literally something called Shoegate around their oldest grandson. I won't get into the details of that, but they did not like that attorney's son. They did not invite him to Christmas or Thanksgiving. And they told me we would leave him out of the estate plan, but we're so afraid that he's gonna sue his brothers to all end and when we pass. So we weren't able to do that. I said, well, what if we are able to do, so we were looking at a charitable remainder trust. I said, well, let's go ahead and look at giving your sons 20 years of income, your two favorite sons. So we created a charitable remainder trust that's going to pay them lifetime income for their two lives. And we did a term of years of 20 years for their two favorite sons. And so it was an opportunity for us to give a little screw you to the unfavored son. And, but I bring this up here because with the unrelated business taxable income, that company had some unrelated business taxable income 2 years prior. So we did this, was it 21? I forget. We were supposed to try and sell it at the end of the year, and it ended up going into January. But we did not have to worry about that because we got the stock in there about 5 days before the sale. But we were able to not have to worry about unrelated business taxable income because it was not an issue at that point in time for that company. So just because somebody might have UBTI doesn't mean this isn't a tool that you can't look at. The other thing that you have to watch out for is no debt. And I say preferably no debt because there are organizations out there that might pay the debt down. So one situation that I have done, I used to do what a 1031 exchange won't do workshops, talking about a charitable remainder trust for people who owned more than one piece of investment property. And so in one situation, there was debt on 2 homes. We had them sell one home and use those proceeds to pay off the debt on the second. And we put that into the charitable trust and we didn't have to worry about the debt. I also used to work with the Children's Hospital out of Oakland, California. And if you made them the irrevocable beneficiary of the charitable remainder trust, depending on how much debt, they would potentially pay off that debt, knowing that they would be the irrevocable beneficiary of that charitable trust. So there are ways to get around debt if debt is an issue. Yes.
So on the lifetime income, either back to the kids or back to the donor, what's the taxation on that?
So the taxation is whatever the original investment was, it's gonna follow the income. So you're gonna have not only the original taxation of that asset, follow the income, but also how it's invested. So I make sure when I talk to advisors, financial advisors, that they keep away from anything but capital gains tax assets inside the trust. Yes.
So is your thought process with that really that the CRT is a private transaction and they could do something for the 2 boys and it wasn't disclosed? I mean, what was the real thought, or the thought being that at their death, then they would just split whatever's left by thirds, or what?
Yeah, so their estate plan is doing the third, a third. But this is an irrevocable trust that son can't come in and attack. like
Okay,
an
so it
estate
was
plan.
the fact that it was somewhat sheltered.
Yes, because it's an irrevocable trust, and that can provide asset protection. And a great thing is getting the asset outside of the estate for estate tax purposes as well. Something that I'm working, and John, I actually I was talking to Paul Casperson. I know you and I are doing the same thing. So I'm doing a lot right now, taking a look, and I know we're talking about business sales. This is a side, but for people who have IRA assets, you can make them. You can make the IRA, the beneficiary of the IRA can be a charitable remainder trust and avoid the 10-year stretch. And you can stretch it out for the lifetime of the heir. And potentially, depending on the age of the heirs, you can potentially then also add a term of up to 20 years for the grandchildren. So, and I do have a little flyer on that.
I give a commercial,
Yeah.
on the 15th of October at the Botanical Center, the Mid-Iowa Plan Giving Council will be having their annual Plan Giving Conference. I'll be doing a breakout session on exactly what she's talking about. It's called a T-Crud.
I call it an IRA stretch trust, but.
Well, there you go. T-Crud, sure.
T-Cred's great, yeah, definitely. I'll share with you my slides if you want to use them too.
Oh, sure, that'd be good. I like you. You have better transitions.
Thank you. Now let's, we'll get into a charitable lead trust. This is for when somebody has already sold their business and they have an estate tax concern. So we have the same apple tree and the donor still gets to be the trustee. And the apple tree now, instead of going to charity, will eventually come back to the heirs. And now the apples will go to charity. So this is kind of the converse of a charitable remainder trust. It's called a lead trust in that we're giving the lead or the income to charity and getting a tax deduction. With the charitable lead trust, we're doing, this is for estate tax purposes. So since we're talking estate tax, we have to get big numbers, right? So we take $10 million, we put it inside of a charitable lead trust. And I like to call it just kind of a wrapper around it. It could be a stock portfolio that you just put inside the trust. You don't have to modify how those investments are invested. And plus or minus any growth is going to come back out to the family. And we'll give to charity over time. This one was done when the rates were lower. So we only had to do 18 years. And we gave to charity or your own donor advised fund, $10.8 million. Getting over time, over that 18 years. And that provided allowing those assets to go completely estate tax free. Our estate tax is at 40% right now. So that saved us $4 million in estate taxes. And those assets were then able to go to the Dynasty Trust for that family without having to pay estate taxes. For our families who are above that, I get that 13.61, not many are right now, but after the sunset, I think this tool will become even more attractive. Lead trusts do good in low interest rate environments. Remainder trusts do good in high interest rate environments. So remainder trusts are great now. So this is a grantor style charitable lead trust, and we use this for the income tax deduction. So we'll take $800,000. I did this with an insurance company that was being sold. It was going as an asset sale, and the majority of the funds, I think 90%, was personal goodwill. So it was being taxed in capital gains taxes, but this gentleman, who actually is a friend of mine as well too, he had a sketchy past and kind of fallen into drugs and alcohol when he was younger. And so he decided that he wanted to give 10% of everything. So we went ahead and did, at the time of sale, we pre-funded his charitable philanthropy with a grantor style charitable lead trust. We chose the term of years of 20 years, and he would get back whatever growth happened over his 5% distribution. So $40,000 would go annually to his own donor advised fund. And that provided him an income tax deduction upfront for that future gift. So he was able to get the asset back in the end, and he got a large income tax savings. And so this gentleman, he was sending out, this is more of the donor advised fund story, but he was sending out like checks like every month. His CPA was going freaking crazy. I mean, like he was sending 10 different checks each month to charities that he supported. And so what he was able to do is we could pre-fund the philanthropy using the charitable lead trust. And now he could have his donor advised fund. He gave it at one point in time. You get the deduction up front, and he doesn't have to now worry about all that accounting because of his donor advised fund. The thing to watch out for with a lead trust is here we have 5% coming out to charity. And we have this invested. And there's a phantom tax liability. So let's say that this investment is making 7% over this time frame, and he's giving 5% to charity. Is he gonna have to pay phantom income tax on the 2% difference or on the whole 7%? It's actually John, the whole 7%, because he got the deduction upfront for the charity. So any growth inside of this, he's gonna have to pay taxes out of his own pocket, not from the trust. So just to be cautious about phantom tax liability, but you put muni bonds in here and you don't really have to worry about that, right? So you can choose the type of asset that you invest.
Tiffany, one thing I'd mention is that is not a tax exempt trust.
That is not a tax exempt trust.
So you're not gonna put appreciated asset and sell it, you're gonna keep it. Or you're gonna take the proceeds from what you just sold and put it in there in cash, put it in muni bonds, make the distributions, and then you get it back at the end. And that deduction helps offset the cap gains of what you just sold.
Yep.
Does that make sense?
Yep. So let's take a look at the two different types of lead trusts we just looked at. So we have the grantor style we just talked about on top and the non-grantor. Both of them, the charity is getting the apples or the income. For the grantor is going to get the asset back at the end. They get to keep the tree, they get an income tax deduction up front, but they're responsible for all taxes on growth. For the non-grantor style, the donor gets to give the tree to heirs. They do not have an income tax deduction up front. It's an estate tax play. And there are no adjusted gross income limits. So I met with a family with the Catholic Diocese in Arizona, and it's a publicly traded company. You would know them. And they had hired an attorney out of St. Louis, I think, because she was an ex-IRS agent and what have you. And I proposed a non-grantor style charitable lead trust. You can do this at death or in life. I suggested in life to give the diocese the money now. And the attorney said, but they can't do that because the adjusted gross income limits, they don't make enough to do that. And so, as I like to do, or I learned after my kind of obnoxious father, to not say things in the middle of a meeting. I said, you know what, let me talk to you about that after the fact. So I reached out to her after I got home, looked up the code as fast as possible, emailed her to show her that there is no adjusted gross income limits for doing that type of trust. So we get to avoid estate taxes, get that asset outside of the trust, and there are no limitations on the client's income. So I have a friend in Arizona who loves to do these super clats or O-clats where you can combine the two of them. And he's charging $50,000 to do one of them. I have attorneys who will do it much cheaper. He and I actually, when he came into town, we started officing together. So there is a way to kind of put the two together. It only fits for people who are making over $1 million because you do have, $2 million a year. You do have adjusted gross income. Charitable stock bailout. So I talked about fringy on the code. This might be a little fringy. So be careful when you do this. So what is a charitable stock bailout? This is great for people who are trying to do an internal transfer because they can transfer to kids and retire some shares. So we have our stock in our business. It could be any type of business. And we're going to go ahead and have the owner donate that to charity. They get the full fair market value deduction from that gift. And then they or their corporation actually buys it back. Sounds too good to be true, right? Well, the thing that you really have to watch out for is the charity's under no obligation to sell the stock to anyone or any entity at any time. So it works out good for, let's say we have a business owner. He owns 100% of the company. He wants to get his kids involved. He gifts 25% of the company to his kids via a trust or what have you. And then he donates his 50% to charity. The company has to have a lot of money sitting inside the company, then buys that back and can retire those shares. Now his two 25% kids have 50% each of the company. And he's no longer an owner. The only time I've really seriously taken a look at this was a real estate company, and I'm actually doing it now, I think, with the Oklahoma Community Foundation. But that a real estate company, a lot of assets were sold. There's a ton of retained earnings. They want to make a gift, and this might be a strategy. Just don't know if like the Community Foundation of Greater Des Moines would want to be that charity. You have to make sure that you've, got your I's dotted and T's crossed. Little sketchy, but in a situation, this could be a strategy that could happen, especially for an internal transfer.
That was actually one of my questions. So we have a client right now who's in this situation, so it's a closely held business. Wants to donate to, it's actually the Cedar Rapids Community Foundation. Has to be sold right away, back to the business.
Okay,
So the question being, we're actually looking into it, to see if it can happen, but how, I guess, one, how would it be valued? For the donor, for the foundation, and
definitely have to
How
get
does
an
that all work?
outside appraisal. And the person that I go to for this is who John works with, Brian Klontz at Charitable Solutions LLC. He's gonna be, and I have actually some information about them on the later slide. What was that?
I'll hook her up.
Yeah. But I would take that situation to him and he'll be able to tell you any legal ramifications and the more complexity on that. So I mentioned pooled income funds, and pooled income funds had gone out of favor. And now they're back because you can do this for an individual. And John, I think your pooled income fund is just you, right? Like you and your family. It's not with a charity that has a bunch of pooled income funds.
Actually, no, it is.
It is? Okay, great. So what a pooled income fund is, it's similar to a charitable remainder trust in that we're gonna take a look at $1 million appreciated asset, put it inside a pooled income fund, and we're gonna sell that asset tax-free. Now, great question on the charitable remainder trust about how the income's taxed. Remember that we talked about the original asset, that's gonna follow the income. With a pooled income fund, it just drowns in the pool. I don't get it. But the taxation of the original asset goes away. So you're able to get an upfront tax deduction, just like a charitable remainder trust for that future gift. And you can give income to up to 10 people's lives. Now, this could be a 3-month-old. All you have to have is a heartbeat and a social security number to be an income beneficiary. The difference is this remainder. For charitable remainder trust, there's this rule about 10% of the future interest going to charity. There's no rule about that here. So that's why you can take income for up to 4 generations. So this can be a great tool for those people, and the charity can also be your donor advised fund for who have a highly taxed asset and want to give income for generations. So existing pooled income funds, so this is kind of the way that it was more so, in my opinion, in the past, where you have the community foundation, the university, what have you, creating this pooled income fund, and everybody puts their money in, and their deduction is based on the last 3 years' performance. A baby pooled income, if you want to get into your own hot tub, that it allows you to use the last 3 years of AFR rates. It takes an average of each year, and it's going to choose the highest rate. So you want a pooled income fund in a low interest rate environment. Last year, Eaton Vance has now created the only mainstream pooled income fund that I know of. And I helped a client, he was out of New York, and he had a venture capital investment come in. And he was already making $1 million. He got another 1.5. And we were able to put him into the Eaton Vance Pooled Income Fund. He got a 54% deduction. It was very nice last year. This year, comparative to a charitable remainder trust, next year, not going to look good. and probably not for quite a few years, because of the way that it's calculated. So this is an example of two 65-year-olds. So this year, 2024, they were able to get a 42% income tax deduction. That gave them the tax savings, and we invest that over their lifetimes. They took income for the two of their lives over 30 years. That gave them $2 million. And the idea of the pooled income fund is that the original investment goes to charity. It's not always quite the case, but and then we look at if they paid the taxes and kept that money working for them after tax, you can see that there was almost a $2 million benefit by using the pooled income fund. But again, the charity got about $1 million, so about an $800,000 benefit to the charity. Awesome. So opportunity zones are a great tool where if somebody is, we know a 1031 exchange, right? Kick the tax can down the road. But with an opportunity zone, we're able to just take it was created to have economic impact on the community. But what you're able to do is you could take a portion of your proceeds. So let's say you have $1 million investment, you sell that, so $1 million business, you sell that, you could take $100,000 or what have you, put it inside a pooled income fund. You kick the tax can down the road until you have to pay them in April of 2026. And so you get to a few years before, well, a year and a half before you actually have to pay the taxes on it. But then the next 10 years of investment, you have to stay invested 10 years, is all tax-free. So it can be another option and a non-charitable option to be able to help someone who has had a highly appreciated sale. ESOPs. ESOPs are absolutely fabulous. I worked on 2 of these when I was a financial advisor, and one of them was a pool company. And their supplies that they were using went down by over 50% because the employees now own part of the company. And that is so important. And it makes millionaires next door. I was just meeting with somebody who had made $20 million just by working there for 20 years. So it's a great thing. However, the cost of implementation, you're looking at about $300,000. It's going to take you a year, and you have to hire somebody to actually manage and do all of the reporting and audits and valuations and everything every year. Fabulous tool. I just met with a company that does, they do the leveling for parks, and they were looking at doing an ESOP or an outright sale. And the ESOP is going to keep their culture, and that's what's most important to them. Great for culture. How many of you know about the 1202 qualified small business stock? And that strategy. So qualified small business stock gives you a $10 million or 10 times your basis exclusion. It only works for C corporations. You have to be a C corporation. You have to have the investment for over 5 years and follow some of these other guidelines. But when you're able to do a 1202, in Arizona, I didn't look up Iowa, but there's no state tax either. Some states will add state tax on there. But if you have somebody who has a C corporation, you have to figure out if they qualify for the qualified small business stock, because they could sell it almost tax-free. And there is the opportunity to do a 1045 exchange into other businesses. So let's say somebody has a $10 million business. It's a qualified small business stock business. They want to take $1 million off the table and invest $3 million into 3 other companies. They can now get a $30 million deduction for each of those companies. So not enough people are looking at strategies with this. It's almost like you need to go find like a list of C corporations and make sure that they know about the qualified small business stock. CPAs are supposed to be the ones talking to people about this, but they're not doing it. So if you know anyone who, if any of your clients have a C corporation, at least look at what the qualified small business stock is. So with that, there's a lot of opportunities, but as advisors in the room, when we talk to our clients about charity, whether it's using one of these charitable tools or another instance, we're able to connect with our clients on a deeper level. If you're a financial advisor and markets are down and you've been talking about charity or helping them with some of these charitable tools, are they gonna run when markets are down? No, they're gonna stay with you. You're able to retain your clientele. Also, who goes to cocktail parties and talks about their amazing estate plan that their attorney drafted? They will go to cocktail parties and talk to their friends about how their advisors are talking to them about their passion and what's important to them. Next generation, who wants to talk to their kids about their money, but they will talk to their kids about their philanthropy. So especially for financial advisors, how much of your assets are lost? Like 70% when somebody dies, that it actually goes into the next generation. So a way to get to know the next generation and increase that relationship. And for financial advisors, a lot of the tools I mentioned need somebody to manage those assets. They need the fiduciary responsibility of having an asset manager. So more assets under management for you. Just know that you're not on your own private island. There's specialists out there. Their community foundation is here to help you. Other nonprofits, I talked about Charitable Solutions and how they're able to help with complex assets and, potentially the charitable stock bailout. Realty Gift Fund, they do real estate. So just start the conversation. There's people out there to support you. I gave you my cheat sheets. And then there's one also on charitable giving. And with that, I'll just ask you to, hopefully this change your perspective on tax advantage business sales. And here's some information if you need it, where I got some of my stuff and some other. And I'll show you my disclosure, but since I'm no longer licensed, I don't even have it.
All right, so before we close up, we have about 10 minutes left. I want to get you out of here on time, so we'll get you out hopefully in 8 minutes. But I wanted to have opportunity to ask some questions. Our moderators are looking at our Q&A section of the virtual as well, so please send any questions through that. Open it up for questions. I want to allow you to have the time to ask anything that you heard today. We heard a lot, but if there's any desire to have any final questions for Tiffany.
And just know that it is a lot, but it's to wet your whistle, to get you thinking about all the different options out there for you to have the conversation with your client and then bring in the specialists that are within your community to be able to have these deeper conversations with clients.
Okay, a couple of things that I'll add. Feel free to jump in if you have questions. I do want to circle back on a talking point we're here today about S Corp. Obviously, 75% of small businesses. It's a great statistic to have. How you can work with Community Foundation and our donor advised fund platform. Carla, do you just want to talk a little bit about what's available in combining S Corp with donor advised funds?
Oh, that's awesome.
Stand up so everyone can see me. Well, I
Maybe
just
come
wanted,
to the front
I
for the.
just wanted to say, we do have a trust created, so we have accepted a number of S corporation stocks over the years. And we look at all the different kind of tax planning for that as well, knowing that there's gonna be taxes paid on it and possibly UBIT. So
Yeah.
we always take that into account. And then when we think about supporting organizations, we haven't had one yet from a donor. We have a number of supporting organizations ourselves, but it is something that we've talked about over the years and would be willing to have conversations if there's donors that are interested in that.
Thank you, Carla. So just wanted to close the loop on that. That is something that we offer here. I just worked with a key stakeholder in a business last year with S Corp, so worked out real nice for him.
Well, and I gotta give you guys credit for that, because I have not met a community foundation yet that is that advanced. So that's great.
We have a neat calculator tool. A lot of hats off to Carla that calculates tax implications going directly to the community foundation versus our trust. So there's options there. So wanted to close the loop on that. Couple other items. One, I mentioned it before, we will send out these slides and a recording. Again, it's a great tool. I want to thank Tiffany for allowing us to do that. Not every speaker shares those slides, so thank her. Another item is for those of you who aren't familiar or don't know that we offer something called our strategic giving services. Tiffany talked a lot today about how do you get multiple family members around the table. As advisors, we know client retention is important. Bringing in that next generation of the conversation is so crucial to our line of work, and philanthropy is a great way to do that. So we have a team here, Sarah Ramsey in the back. leads that effort, and she sits around with 3 generations of people around our table here that can find it very, very cool to see those conversations happening. Last, charitable trusts, awesome tools. You learned a lot about these complex tools. She kept mentioning that a donor advised fund can be a beneficiary of that. We're happy to come alongside you in conversations. We don't draft those kind of documents, but we can connect you with people in town that do. And then also have that conversation about if they have a specific fund here or want to create one, or just they have a designated beneficiary. Maybe they're just really big fans of their church or the YMCA. We can have that kind of remainder beneficiary interest come through here as well. So just wanted to let you know that it is an option.
Well, and I always like, if it is a remainder beneficiary, I like them to get it started now. Just so that they can start living into that charitable legacy that they can create. So even if it's at the, what's your minimum for a donor advised fund?
Don't have anyone.
Oh, awesome. Donor.
Any other final questions for us? Wonderful. Well, thank you all for coming. Again, we're here as a resource for you. Happy to meet with you and or your clients as you have a great rest of your day.